traders. I'm Dennis Dick, and this is Pre-Market Info.
And I'm Joel Elconin. And during today's presentation, we are going to analyze liquidity in the first few minutes of trade. We are going to look at the market pundits that say HFT trading has increased liquidity and narrowed spreads, a notion that may be true in the middle of the trading day, but does not appear to be true in the opening minutes of trade. Going to use UTX as an example off the open, and Visa as well, trading with extremely large spreads. Also discuss other stocks that had wide spreads and very little depth as well. Let's begin, Dennis.
Want to start with UTX. It had earnings here today. I'm going to show you what you're seeing here is the tape, the time and quotes of UTX from this morning. So the time here, 9:30:26. This is the price, the last price. The size of the trade, so you can see 100 shares, 60,000. That's the opening print. 72.90 is the bid price, 73.50 is the ask price, and this is the bid size right here, this one, and this is the ask size, this one. So you can see here the opening print on the NYSE. It opened at 9:30:26 with 60,000 shares. Right off the bat, the quote just for a split second is actually 60 cents wide, but it does narrow. It's only 40 cents wide, 73.10 to 73.50, right in that opening print. But if we continue to scroll up, you'll see trades going by. You'll see the spread's tight, a little bit tighter here at 14 cents, 73.16 to 73.30. But the spread does start to widen actually. So if I just continue scrolling through the tape, now you can see at 9:30:40, the spread is actually 22 cents, 73.17 to 73.39. So here we are, UTX. Big high volume stock. It's actually already traded 3 million shares today, but right off the hop it's all 100, 200 share trades, and 20 cents or 22 cents is the spread here right off the hop.
And you got a couple in the fact that probably since they had earnings out, a lot of people that would play the opening trade based on fair value in the S&P are probably not present in the stock. But where are liquidity providers in this stock off the open?
Well, that is off the bat, obviously with earnings stocks, you have a lot of people, there's risk involved, and this is what we've said all the time, is that high frequency traders provide liquidity when there's no risk. When there is risk, they're not providing liquidity out there. And you can see here, even on UTX, look at here at 9:30:46, the spread is 73.13 to 73.42, 200 shares by 100 shares. That's not a very deep market. Even though this thing had earnings, that's ridiculous. It's 29 cent spread here on a stock that's going to eventually trade 3 million shares, and we're only an hour or 2 hours into the trading day now as we're recording this. But this off the bat at 46 seconds, because you're looking at the current volume up here for the day, but it hasn't really traded any volume yet. And there's nobody providing liquidity out here. These high frequency traders have eliminated all your human market makers. So they are now your only market makers that are out there, these high frequency traders. And right off the bat, they don't provide liquidity, and especially on an earnings stock.
Well, I hate to harken back to the old days where you had human market makers actually having to post bids and offers, but they would be required, if you were a market maker in that stock, you would be required to post a tradable bid and offer off the open as soon as the stock went into motion, and there would be competitive competition between the market makers, and it would make the spread. There's absolutely no legal restrictions on the computers, the high frequency trading. They can trade whatever they want. There's no guidelines for them at all.
Yeah, well, and what you're talking about is affirmative obligations. Back in the day, there was the specialists, there were the market makers. They had affirmative obligations where they were required to come in and provide liquidity when nobody else was required. That, for the most part, doesn't exist anymore. The high frequency traders have no affirmative obligations. They are your major market makers. So when there is risk, they do not provide liquidity. And they don't trade during these times. And once the risk is gone and once the price is getting set, then they'll come in and provide liquidity. But the concern for us here, like look at this at 9:31:40, I'm just looking at another tape, 73.48 to 70, it's 19 cents spread still. Let's just scroll up a little bit farther. There's some other interesting ones too. I'm going to scroll, it's wide, it's 17 cents. Like this isn't just an isolated event. You can see as I'm scrolling through, the spread is staying wide and all the shares are 100, 200, 300 share lots. There's no like 5,000 shares. If you want to try to liquidate 5,000 shares, good luck. Good
So
luck.
don't trade that. Just don't trade that.
But what happens if and this is, okay, so for your retail traders, that works. Don't trade at the open. It's good advice. Trading right off the bat doesn't work. But if nobody's trading off the open, what's going to happen when we have a market impact event overnight and the stock's all open? There's no liquidity. There's no market makers. What's going to happen? We're going to have a vacuum. We're going to have this vacuum where there's no liquidity and the market's just going to tank and we're going to fall like 2,000 Dow points in one day, and everybody's going to be like, what happened? Well, the market structure's built this way. It's not built it's built to crash. It really is. It's built to crash because we have liquidity providers when we don't need them, and we have no liquidity providers when we need them.
And you could take note here that this was an up opening. So people are happy the market's opening up. You should be, based on what Draghi said, everyone should be flocking into the market and buying stocks and listening to Jeremy Siegel. We're going to 20,000. What happens on the big down opening?
Yeah, this was a big, yeah, exactly, Joel. This was a big up opening day. So there isn't fear out there today. There's excitement. We're making money. And there's still no liquidity. 74.55 to 74.87. This is a 32-cent spread here at 932.14 UTX. This is over 2 minutes after the open. The stock has a 32-cent spread, 100 shares by 100 shares. How is that a liquid and deep market? How is that? It's all 100 shares.
Oh, you just got lucky. You just found this in UTX.
Nah, I just found it in UTX. Let's look at Visa. Let's look at Visa today. Let's go analyze the charts from Visa. So as you can see, I'll scroll it down here. Just off the bat, an opening trade. So there it opens at 125, 72,000 shares. Let's look at the opening print. Okay, 20 cents. Well, it's a $125 stock. A 20-cent spread doesn't seem ridiculous. But let's keep scrolling up here. Let's keep scrolling up just a little bit, and let's analyze. Okay, so here we are at 9:30:21, just about 10-15 seconds after the open. Look at the trades that are going by. 124.99 for 100, 124.92 for 100, 124.52 for 100, 124.50 for 1,800. Oh, back up to 124.99 for 100, 125.03 for 100. 124.97 for 100. Oh, back down to 124.50 for 100. 100 shares knocks it down 50 cents. Look at the spread.
And you know what's really sad about this, too, is that a lot of the times, a lot of the orders that are executed off the open are simply market orders.
That's it.
Coming in from uninformed investors, and they are getting raped.
They're getting raped. It's a little guy that's sending a 100-share order to sell at the market on Visa, and he's paying 50 cents or 70 cents. Look at this spread right here. Look at the one I just found, 930.21. Visa has a best bid for 200 shares at 124.20. Best offer is 125.01, an 81-cent spread here in Visa. 10 seconds after the open. So if you send a market order, this is what happens. You can see, selling at the market, you get 124.49. Buying at the market, you get 125.07 or 125.15. These are real trades, folks. We didn't make this stuff up. This is what your market looks like.
UTX had earnings, all right?
Okay.
And Visa's $120 spread, so I think you're still
And it had
reaching.
earnings too. So earnings last night. So you're right. Maybe it's just the earnings stocks. Let's look at Eli Lilly today. It didn't have earnings today. Let's go analyze the trades in the opening first few minutes of Eli Lilly. So here you are, the NYSE opening print, 930.13, 90,000 shares trade at 43.87. Scrolling through, okay, it's a 4 or 5 cent spread. That's not ridiculous. Oh, wait, what happens? Oh, now it's a 14-cent spread, 73.57 to 73.31, or it's 73.71, 100 shares by 100 shares. Nice tight spread. If you want to sell 100 shares, you want to sell 1,000, I don't know how you're going to get done, but if you want to sell 100, you can pay 14 cents to get done. Oh, and here we are again, 16-cent spread. There's no news here on Eli Lilly today. This is just the spread. This is literally the spread. It's trading in 100 shares all over the place, trying to tighten a little bit, 7, 8, 10 cents here after the open. These are 100 shares. It's 100 by 100. How do you liquidate 10,000 shares? I can't even imagine trying to liquidate 10,000 shares of Eli Lilly here right now. Back in the day, you had 10 or 15, or you had, remember when we had fractions, Joel? You'd have 16ths or 8ths. There might be an eighth spread. So let's say that would be 12.5 cents. But there would be like 10,000 or 20,000 shares on the bid. There'd be size on the bid. Now we've got these spreads. They're 100 shares by 100 shares, and they're just as wide off the bat. How are we better? How is the liquidity better?
I read back when you did have a trade in 16ths and 8ths and whatever, you had a $50, $60, $70 stock, and whenever it went to like even a buck spread, 100 up. You knew there was something new, there's
That's exactly.
something big coming down the pipeline. Now it's the status quo.
That's a status quo. When you seen, and this is how the specialists used to do it back in the day, when they put a one up, and then we would call it one up when there's 100 shares on bid on the 100 shares on the offer. That meant the stock's not trading right now because there's news or there's some market impact event, and the specialist is analyzing liquidity or putting together a trade on the floor. So he's doing something big that he can't be trading it right now. So he puts one up, 100 shares. That's the only time you've ever seen 100 shares by 100 shares on these big caps. Now you see it all the time, and the spreads aren't any really narrower. They're narrow during the day. Like, let's look at liquidity. If you look at Lilly right now, it's got a 1 cent spread because there's no risk. The price has already been set. But when you're setting the price off the bat, there is no high frequency trading firm setting those prices. They are not trading during this time, or you get the aggressive high frequency traders that are actually moving the prices around to where they want to move them around because they can at this time. When there's no liquidity, you can easily move the price to where you want to move it. So if you've got a big position on, you can just move the price to benefit where your overall bigger position.
And also a lot of the retail order flow that's coming into the market off the open or within the 10 or 15 minutes is never making it to the trading floor or to the prior whatever market makers are left. Unless it's a losing order, because the internalizers will automatically take the other side of that order before it even gets to the primary market makers or the specialists.
Yeah, that's exactly it. You don't have any retail order flow really getting into this market anymore. It's filtered out. You have participants, high frequency internalizers buying retail order flow from brokerage houses, and they trade against the stupid orders. They trade against those market orders, and they make these spreads. And what happens is you have no liquidity in the lit market, and liquidity continues to get less and less. Our traders don't place limit orders anymore because if you put a limit order out there, you don't get filled for the most part. You usually get stepped in front of by a sub penny or some high frequency penny jumper, and you don't get filled. And when you do get filled, it's because the quote just bulldozed right over you. If you're bidding 73.61, all of a sudden the stock's trading at 73.50, or if you're bidding 43.61 in this example, Lilly, all of a sudden the stock's down at 43.50 and you're down 11 cents. Limit orders are abused in this market, and that's why we don't have the liquidity. So the main reasons that you don't have liquidity is because these high frequency traders, and it's the main reasons is just the fact that there's no incentive to post liquidity anymore. There's just no incentive to post liquidity.
And how did the government allow us to get into this position? And now that they've got us into this position with very little stable liquidity in the market, how are we going to get out of it?
Well, that's the question too. How do you re-incentivize participants to display limit orders? You've got to start giving that incentive. And then when you have stuff like the NYSE getting approved on their new dark pool, everybody's going to the dark. Everybody is trading in the dark now. So there's absolutely no reason to display liquidity. All the order flow, all the good order flow, the retail order flow that you want to trade, that traders want to trade against, is in the dark. And that's why the NYSE is allowing their market makers to go and trade in the dark now too, because they want to get a piece of that action. But when everybody's trading in the dark, nobody's trading in the lit market. And here is the problem. Here is the overall problem. The dark price is set from the lit market. So you're incentivizing everybody to trade in the dark, and nobody's going to set the price anymore. And eventually, the only participants that are going to be setting the price are going to be the same participants that are setting in the dark, and then they can really screw over the retail trader.
Perhaps the solution would be to mandate these high frequency trading firms to post a firm market from when the stock starts trading on the primary exchange. I mean, I think that would eliminate a lot of the problems you're talking about.
It would help, but you need to incentivize real traders in there too. You don't want the same market makers that are controlling price. You're eventually going to have 5 or 10 firms controlling the entire market, which is crazy, because those are the firms that have the fastest computers and are going to be controlling the price. So you're eventually going to have this monopoly where there's 5 or 10 firms that control, and I think you already have that, but it's getting ridiculous. But what you need to do is incentivize other participants to come in and start trading in this market and posting limit orders, and by allowing participants to step in front of your order by a fraction of a cent. I've wrote on this on the blog multiple times. Nanix just put out a piece on it. Suggest you read it. I'll put a link to some of this stuff under this video. But you need to check out, we need to incentivize those participants to come in and provide liquidity once again to this market.
We're talking about dark pools, Dennis. Are we just living in the dark ages by actually thinking that humans can post better markets than computers?
I sure could on May 6th. Remember May 6th flash crash when computers were selling stocks at 1 cent? At least a human being can rationalize. A computer can only do what it's programmed to do. And I'm not saying kill off the computers, and I'm not saying, the high frequency trading is all bad. I'm not saying that whatsoever. I'm saying we just don't have any incentive to display liquidity in this. So you can't give participants a free look at other people's orders. You need to level the playing field, and then maybe the retail guy, maybe confidence will come back into this market, because right now it's just a vacuum here off the open. Liquidity is a vacuum. The liquidity is a joke. When you see the stocks like I was showing, like UTX, that have a 35-cent spread 2 minutes into the day, I challenge any scholars who listen to this video out there, analyze spreads in the first 5 minutes, because it skews the data. When you have spreads, when you analyze spreads throughout the day, well, we have tight spreads from 9:45 till 3:45, and when there's no news coming up. But we don't have tight spreads around market impact events like those 10 o'clock economic numbers, or at 9:30 in the morning when we first open. Analyze spreads in the first 5 minutes. That's what I want somebody to do out there. Get all the analysis. You got to crunch all the data. Analyze spreads in the first 5 minutes, because I can see it. I'm a prop trader and I can see it every single day. These spreads are getting wider and their buck is getting thinner.
Okay, I guess it's Joel and Dennis trying to turn the clock back on computers and high-frequency trading. We appreciate any comments or questions have on our presentation. Have a good day.